All right. All right. Hello, everyone. My name is Brian Miller. I'm the head strategist for Optimized Trading and Equity Sciences. We primarily design, highly adaptive, quantitative solutions for literally biased market types. Today, we're here to review some of our concepts, philosophies, and products and services. Before we get started, read through this disclaimer. Historical performance, whether live or simulated, may not be indicative of future results. Trading stocks, ETFs, futures, or FX can involve significant risk that may not be suitable for every investor. Investors should only choose to invest funds they can afford to lose without negatively affecting lifestyle. Price characteristics are not predictable or repetitive, thus any strategy developed from historical data will be equally unpredictable. We do not guarantee nor claim our strategies will perform positively and or reflect their historical results. In fact, there can be significant differences between historical and live results. Please consult your investment professional before choosing a trading or investing strategy to ensure it meets your investment objectives and risk tolerances. All results shown are historically simulated, not live real. All information data presented is my personal opinion, as I am not an investment advisor, thus do not consider investment advice nor solicitation of any individual product, service, and or equity. All right, so so before we dive into the specifics of product, let's share a little about the process. And for us, before we got started, we really looked at what are the primary risk factors involved in the marketplace, and how other quant firms and models, et cetera, fail. Time and time again, that answer comes back to a randomness, and then also outcome dependency. And so what I mean by that is whenever you design a source of alpha or a strategy or a model or whatever, and it's designed explicitly to exploit a very specific type of value, whether that's momentum or reverting or some source of alpha or whatever that might be, it's singular in nature. So, and typically the further you go down into the research rabbit hole, if you will, the more nuanced that alpha source can be. Meaning,
hey Brian.
Yes.
Sorry to interrupt you. Your slide is just showing up very small on the screen, like it's only showing up as a small portion of the screen. That's weird. Okay, yeah, that's
okay. All right, there we go.
Yeah, okay, that's better. Thanks.
All right, yeah, good. So so an extremely nuanced source of alpha, which can be very environment dependent. Well, as we know, the world in which we live evolves at a very fast pace. So for us, we tend to keep our underlying strategic concepts very simple, very creative, but also simple, aligned with John Conway's works on rules of complexities. And so, and the other commonality that we found is no matter what type of firm, fund, etc., they all deploy diversification. And there are a plethora of justifications for that. And so, one thing that we also found, though, is they don't deploy diversification on a per asset outcome basis, meaning, if they choose to include an asset, then usually it's singularly based, right? Either it's a buy and hold, or it's a short-term type of buy and hold, more like a like an quote unquote active asset manager, or it's a single source of value that they're looking to exploit from a quantitative perspective. And so what we tend to focus on is finding ways to integrate the benefits of diversification, but intra-product based. So intra-asset, right? So each asset's outcome isn't based on anything of a singular nature, whether that be a single type of value, a single market environment, a single substructure, or or even a single source of analytic or anything like that. So we really look to magnify the benefits of diversification and to diversify the factors that produce outcome, right? And it's a very logical thought process. However, it's really not that heavily integrated. But we found a way to do that with our products that allow us to exploit multiple variations of value, multiple market environments and substructures. And then we simply apply, highly adaptive, exit logic, allocation logic to that within our alloduct structure or model, primary model. And so, but our process, everything begins with the data, the data, the biases, behaviors, and characteristics of that market. And what I mean by that is it doesn't make sense for us to design, a momentum strategy on a market that's heavily reverting, right? And so, for instance, like there's some assets that just organically have more reverting characteristics or more momentum characteristics. Like AT&T is a great example. It's heavily reverting, and then indexes are more, on average, are more reverting than an individual stock because it's diversified, right? So you have more tug and pull there, more ebb and flow. And so we look at that as trying to throw a rock in a river and expecting it to mimic its flow, right? So all of our strategies and concepts, we just want to mimic the flow of the characteristics that that asset organically produces on its own. So we just want to go with that and not fight it, and design a strategy that we apply to every asset. So every model that we design is designed for each asset independently for that asset's characteristics, right? And so next is strategic and result objectives. What is the objective of what it is that you're trying to do with that market, with that asset, with that model, et cetera. And then we design condition-specific alpha and smart beta, and we use a structure that I'll go into in a little bit called market classification. And then we diversify factors that produce outcome. And we do that by, simply allowing multiple entries per position and then exploiting, multiple market environments and substructures, and then implement layered intellect. And what I mean by that is nothing is set in nature, right? So we don't have no set risk returns. We don't have any set allocation. Everything is dynamic and it's adaptive to the asset, to the current market environment that we want to identify, to the model that deployed it. And so, the more layers of intelligence that you can integrate, the better, right? I mean, it doesn't have to be, deep learning intelligence. It just needs to take some basic factors into consideration of what it's going to apply, whether that be an entry target, an exit target, or if your allocation percentage, and then tune for specific outcome goals, right? And so that can also be when you're looking at more like a group of products, there may be some markets or some assets that's better to lean the tune more towards consistency, whereas some might be better suited to lean more towards growth. And so we just also like to match that as well. And so let's see, let me share. All right, so there's a lot of activity there. I realize that that's probably very different from what you're used to seeing from trading period, from quantitative models, but let me try to explain what you see. Essentially, what we deploy is what's called market classification. And no matter what strategy you deploy, whether it's momentum, value, it doesn't matter. That's what you're doing. You're classifying the market into some type of condition that you're looking to exploit, right? But we do it a little differently here. So what we do instead is we break the market down into either 32 or 64 repetitive market conditions and substructures. Obviously, some are more dominant than others. Some may last for longer periods and be a little bit more infrequent. And then some might last for shorter periods, but be more frequent, right? And so what we then do is once we classify the market into 64 conditions, and at any point in time, the market will fit in with one of those 64 classifications. We then look at each one of them to say, hey, historically speaking, whenever this classification occurs, does it offer a positive payoff matrix for long positions? Does it offer one for shorts? If so, what is the best type of value to exploit there, right? Is it momentum value? Is it reverting, random, cyclic consolidation, oversold, etc., right? And so we just look to match the type of value that we want to exploit per condition basis. It's a very simple concept, right? So that way it gives us the ability to exploit multiple conditions that we identify in a way that's specific, but not and closely fitted to the characteristics of that market, but outcome isn't dependent on any one of those specificities. So while some may argue, well, aren't you worried about overfitting or whatever? And it's true that we do closely fit each one of those types of value per classification basis. But to us, that's a level of efficiency. We want to be as efficient as we can whenever that classification occurs. And obviously speaking, the markets are random, and that's not always the case. Sometimes the classification can lag. There's a whole host of factors that can cause temporary inefficiency within a model structure. But what we look to do is say, okay, how do we mitigate that? How do we mitigate the risks of randomness, right? And so you do that through allowing multiple entries per position, through applying adaptive entry and exit logic, and then allowing multiple entries per position. And your allocation per entry is also highly adaptive. And so, there are, allocation models that I've designed that, are without looking at, optimal entry or exit target pricing at all. It doesn't take that into factor at all. It simply, dynamically adjusts the percent that's allocated to the market at any point in time. And just that alone will pretty consistently, on a historical basis anyway, consistently outperform. So we combine that, with a highly adaptive entry and exit structure, right? And so what you see there is our allo duct framework. And it is, again, it breaks things down to 64 conditions. And so let me show you some historically simulated performance data. And so you get an idea. We use a compounding allocation model, right? So it takes the return from the previous trade, immediately rolls that in to determine what the total is that you have to use for the next position. Each entry can deploy a different allocation percentage than the previous, right? So everything is looked at on a per entry and per position basis relative to the condition that it's in, right? So we look at the level of value that we're seeing within the market. And so everything, we tend to do things a little backward from institutional allocation models, which tend to reduce the allocation based on value and volatility, whereas our models are the exact opposite. They increase the allocation based on value and volatility. And so this model is over, approximately a 25-year data set. Let me show you when it started trading. So started trading in April of '96. Needs a few years of data there to get going. And I will show you how the model behaves in different environments. And we'll start with the most recent. But historically, this is cumulatively throughout the past 20 some years, what the model has historically simulated. And that starts with 100,000 initial investment. So, and that's just a round number that I always use for development. So that's that's just an easy figure to use for all baselines. And so over approximately 20 some year period, let's see what the exact, 26 years, the 100,000 essentially historically simulated that over a 26-year period, profit factor of 6.46, almost 2,000 trades, 84.5% profitability. And so let's go to periodical. And so, 2022, the market closed down, depending on which index you looked at, 17 to 19% or so. Our model historically simulated, as you can see, approximately 22.1%. And that is CARG, which is very different from ROI. That only looks at the percent, that looks at the value from the beginning of the year. So if you were using ROI and you had been trading that model for, 2 or 3 years or 4 years or what have you, then it would be much higher than that because it compounds. So instead of 22%, it would be more like 80%, if you're using ROI from your initial investment, which is, true growth essentially. So, and then, the COVID year in 2020, another 21%. And to show you how the model has performed, here is the start of 2022. And the good thing about these models is there's two kind of risk factors that go along with them. Is the average percent time in market is about 50%, 55%, somewhere in that range. And then the average allocation is about the same. So when approximately 40 to 60% of the time, you're in cash. And when you do have an open position, your average allocation percentage is 30 or 40%, sometimes even lower. And so what we want to do is be as efficient as we possibly can on that initial entry, because the more efficient that initial entry is, the better. So we want to be in and out as quickly as we possibly can, and then just reinvest that return. And so that allows us to not have to seek a large percent return on a per entry basis or whatever to outperform. So we can apply an adaptive exit model, as well, and which is also multi types of exits. So we have like intra-bar exits and then into bar exits, per entry profitable exits, and then per position. Now, the model does not have any stop losses. It does have losing exits, however. So we do have losing exit criteria within the model structure, just not an actual max stop loss. So, and being it's equities and not futures markets, the risks there historically for this model anyway, I can send you, we typically calculate that based, because it compounds, you have to calculate your risk based off where the market was at the time of the trade and not what your initial investment was. So that's how we calculate, max drawdown percentages and things of that nature. But I think for 2022, it was like approximately 6.5%. That was our max position drawdown of 2022, and the max drawdown of the SPY was, I think, maybe like 23%, maybe 24%, somewhere in that range. Again, approximately, but you can see the difference there. So the risk and how we accomplish that is, we don't put all our eggs in a single basket. Essentially, we are looking to compound probabilities, right? So ultimately, nobody can predict the market. No model, no matter how efficient, how intelligent, how adaptive, the markets are completely random. So what we are looking to do is exploit the same fundamental and behavioral justifications that all the buy and hold and active asset allocation firms, funds, managers deploy, right? We want to exploit the same biases, the same justifications that they do. We just want to do it in a more effective, more efficient manner, right? And so, that's one reason why we also allow multiple entries. So that's two factors. So that has two benefits. One, it allows us to spread out that position allocation more intelligently, more effectively based on value and volatility. And then in addition to that, it allows us to compound the probabilities of the individual models or types of value that we're looking to exploit and how we identify that, right? And so, our model here exploits, reverting value, random, cyclic, consolidation. And consolidation is kind of splits into two kind of two layers. You kind of have like small cycle consolidation, and you have large cycle consolidation. Like this would be, a large cycle consolidation, right? And then we also have obviously oversold, right? And then you have those forms of value, and then relative to how we classify the market, right? And so you can have an oversold that occurs in a bull uptrend compared to an oversold that occurs in a downtrend, right? In a large cycle downtrend or in a large cycle uptrend, right? So we look at those differently, right? Because they can be, the types of value that you want to exploit historically can be very different. And so we just want to be as specific as we possibly can, but without being dependent on any one of those singularities, if that makes sense, right? And so this is 2022. Let me show you 2020, which is the COVID year. All right, so this is 2020. And so you can see here, we have some per entry exits. That is, intra-bar exits that can exit without, the next bar closing. So, we have a wider, we want to essentially give this model as many ways as possible to exit with a positive outcome. Instead of just giving it a set, it's going to pursue a 1-in-1 or a 2-to-1, return, whatever. No. So we want all of that to be, based on we want to give the model per entry exits, per position exits. And what I mean by that is, let me see if I can move this. All right. All right. So this right here is a per position exit. All right. So that exits the entire position. This right here is a per entry exit. Okay. So it just exited this entry right here with a return. And so it's very critical that you give these types of models both, right? Because you want you want to take that risk off the table. Not only are you taking that risk off the table, but you're also securing a closed return while you're holding, an open position drawdown. So that closed return helps mitigate some of your open position risk to some degree, right? Because when you've closed this, right, you've taken those shares off the table. You've also secured the return that generated. So the drawdown that you're holding from this isn't as significant at that point, because you've mitigated that to some degree. So that's a very important structure that we deploy, is both per entry and per position based exits, and all of those are dynamic. So nothing is set, all is based on price characteristics. So all right, so that is 2020. Let me show you 2018. Okay, so you see the market, this was in a strong bull market in 2017. The market's going up, obviously overbought. The market bought two, held an open position drawdown, and then as you can see, it started identifying a different type of value, started deploying again, and all these shares are different from each other for various reasons, because the type of value that exploit, as well as the close price using that as a divisor. So that also helps compound value from the percent available that's applied. And so, but a lot of these closed out rather quickly with a closed return, which mitigated or even surpassed the open position risk that you had here, right? And so, you see that again here in a few areas. And so the model can scale in, it can scale out, it can scale in, be all out. So we really look to be as adaptive as we possibly can. And a model will only do what you tell it to do. And so that's another reason why, we really try to give it as many ways as we possibly can to exit with a positive outcome, whether that is exits that are seeking to maximize return, or that is exits that is seeking to protect return, right? So we look at it in kind of two ways there. So here's some kind of large cycle consolidation. Occurred in 2015, 2016. You can see how the model behaved there. And again, this is all really due to our method of market classification. So we understand that volatility is very important. So we look at that very closely. So we break it down very closely. We also realize that identifying overbought and oversold is very important. Not only identifying it, but how extreme it was. So whenever we are breaking things down, we're just not saying, well, is something true or not, or is it increasing or decreasing, but we're also looking at the level that it is, right? And so we can equalize that out over the past year or 2 years or 3 years to find what are deviated levels and what the level of deviation is, right? And so this may sound overly complex, but that's the beauty of it, is technically speaking, these are very simple strategies. From a strategic perspective, they're very simple. It's just creative in how they are assimilated, and the structures that we deploy are just highly adaptive. That's all, right? But strategically speaking, we're not exploiting nuanced sources of alpha. We're not looking at sentiment data. So we keep that very basic to some degree. We like to think that our underlying concepts are creatively simple, but in the world of quantitative finance, there it goes light years down the rabbit hole if you want to. I mean, you can break out like satellite data analytics as well, but we don't do that. So everything is based off price data, volume data, etc. So but market classification gives us the ability to break things down on a repetitive nature and measure it, right? Not only what types of value are best to seek, what types of allocation is best to seek, but how they perform relative to each other. So you can find some predictive patterns there, like, hey, if classification 32 occurs for more than, let's say, 4 weeks, then there's a high probability that classification 40 will occur next, right? Or if classification occurred and the distance that price moved was exceeded a certain range, then it was a predictive element for for classification 18 to occur next. So you can get some predictive value from that as well, right? So it's not just everything is just a reactive measure, but you can have some predictive elements that go along with that. And so again, you see the market drops down, it buys, you're holding an open position drawdown, of course, and then you start selling out of some of those positions, which help mitigate your open position drawdown, and then eventually the position closes, and it cumulatively it closed with a positive return, right? That's what you typically see. So on kind of larger allocated positions, the first couple positions might hold a drawdown for some time, and a month later, whenever the position closes, or 2 months later, whatever that might be, after it's all said and done, the entire thing, whenever you look at it collectively, all generated a return, right? While some of the individual entries might have lost, but cumulatively, that's what we look at. And okay, so here is the financial crisis crash of 0809. And you can see we continued going along in that period. And another benefit of market classification is we obviously identified a change in large cycle sentiment, right? And so a different model, a different subset of models would have been applied there for this, compared to a subset for this over here. So it would have been a completely different subset that would have been applied to them. And so, but as you can see, in 2008, 2009, whenever, that's when, exponential growth really started to transpire, because the model is designed to slightly outperform during strong bull trends, however, significantly outperform in higher volatility conditions, right? Like in reverting value, random value, consolidation, higher volatility, higher value types of conditions, right? So, there was a lot of volatility opportunity to be exploited in that period of time. And then the other thing too that I wanted to tell you, here's another downtrend in 2002, 2003, 2001 as well, technically. Some of these can, and it's very important, that we include as much data into our model. So whenever we're designing these models, we break them down to 64 different classifications, but we're also looking at 30 years of data or 25 years of data, etc. So for instance, but one thing that we don't do is use data before about for development, that is. We don't use data before about 1997 for the actual development of the model itself, because market characteristics made a very significant shift in that period, post that period, due to the internet increasing market activity. People had additional access to the market now where they didn't before. So it increased volatility, and we've saw volatility continue to increase within the market as well. And so, we really, I don't foresee, conditions ever going back to, how they were pre-1997. So we really don't use any market data for determining model values pre-1997. Now, we'll still apply the model to market data before then, just to check it, just to run it there and say, hey, okay, well, we get data for this market going back to like 1990. Okay, so let's at least see what it does in that period, right? Because it is different. How about if it does occur again on a short time scale? Maybe it occurs for just 6 months or 9 months or something, right? So it's good to see how that would have performed in that. So it's just a secondary confirmation type of tool that we'll use. But it's really simple, what we deploy, and it's just highly adaptive, right? And I know that all this may sound complex to those that's not within the space, but honestly, that's the joy of it, is you don't have to understand everything, right? You don't have to know, all the subtleties involved with my area of expertise, because that's why we offer the service that we do, right? So this just to give you, a very a general idea of why we do certain things, and the why that we do them. It all boils down to 1, longevity, and 2, risk. Mitigating risks, the risks that come with randomness, the changes in the world that we live, changes in economic structures, et cetera, right? And being able to adapt to that, right? Diversifying the factors that produce outcome, not being dependent on anything of a singular nature, to take the same philosophy that every investment firm in the world deploys of diversification, but integrate that philosophy on a per asset basis, right? So nothing is, it carries a high weighting of determining outcome, if you will, right? And which also in turn allows us to compound positive probabilities. Okay. And so, we at Equity Sciences will be, we are offering this as a signal service, where you can sign up. And on our site, actually, I believe that we are now offering a special. Let's see. There we go. All right. So we're now offering a special. The first 25 to sign up gets free access for a month. And essentially, it's a signal service. So we will be delivering the signals to you. And so we don't sell our software. We don't sell or give access to that in any way. But we just deliver the signals to you, that the execution, as well as we are working on an executing partner now, where clients, if they are a little bit more hands-off, they can sign up and it can be automated within their account structure. So it's for clients that, for potential customers that, maybe not have much time, but because the model's applied to a daily bar, it's not like it's applied to, a 45-minute bar or anything. So from a signal service basis, it'd be pretty easy to follow, essentially once a day, see if there's an update, right? The bar is closed once a day, so the model updates once a day, technically, right? And so it produces, if it has a limit order for the next day, whether it's a buy or, an exit, it offers that the day before essentially, so you can see that, right? So super simple to follow. From an allocation perspective, we actually change the model slightly. Instead of using, from what you just saw the shares continue to build, but for the signal service variant that we offer, it's just a percent. So like, for instance, if it shows buy 5 shares, then that's not 5 shares, it's 5%, because every one of our clients will have a different amount that they will want to apply. So we can't do a shares basis there. So it doesn't make sense because the model deploys compounding. So the model is changed to just reflect a percentage basis. So for instance, if the model buys 20 shares, then that's 20%. If it's 2, then it's 2%, whatever it might be. It's just a reflective of a percent. Super simple to follow. And we can also send kind of like an example of that as well. And so if you have any more questions, that's kind of the basics, guys, of of our philosophy of product. We'll also we primarily focus on indexes and sectors, right? So like SPY, QQQ, and then spiders like XLP, XLU. And so we will be offering those as well. So for now, it's SPY, and that product, the Allo duck that I just showed you, that's been developed, my goodness, for like more than a few years now. So some point in early 2019. So a good amount of time. And so we're essentially take that same Alloduck framework. It's like a V2 of that essentially, with some minor adjustments, but we take that and then we just apply it to a different asset, customize it, tune it to each asset individually. So it, and some of those are slightly altered from each other because the characteristics are different. So we want to mimic the flow as best as we possibly can. And some assets, again, like QQQ, organically is more momentum based than like SPY, because or like maybe like RSP or something like that. So QQQ is more industry singular, right? So it's more technology driven. So there's it's not as diversified as SPY is. So for that reason, it has more momentum characteristics. So the model should be leaned towards that way, right? And so that's how we seek to really develop all of our products, is go with the flow of the data, the organic biases and characteristics that asset produces, and then just mold an adaptive, creatively simple model around it, right? That exploits the same, fundamentals and behavioral justifications that every buy and hold firm, exploits, but do so in, a more efficient and adaptive framework, right? And so, eventually, we'll have, a pretty good plethora of different options there, not just SPY, right? And so, and all that will be on a signal service basis. So, if you have any questions, please feel free to reach out to Rob or myself. Be more than happy to answer any specific details that you might have. And so, the real joy of this essentially is, all these products are meant to be compared against buy and hold, right? So that's what they're designed for. They're technically, classified as like short-term swing. The average position, the average amount of bars in each trade, I think, is about 13 bars or so. But you can have some intraday trades too. So technically the models can open and close intraday, right? That can happen. So there is, because of that reason, there is like a 25K minimum that the account has to meet, because technically the model can meet that day trading regulation policy that so the models can deploy technically. It's rare. It hardly ever occurs. I think maybe for SPY, it's occurred maybe once or twice in the past like 26 years. And then the other thing too that's kind of rare for our models is like to be heavily allocated. Now it does happen, but we try to keep that as low as we possibly can. So the models themselves, we want to keep that average allocation, below 50%. That way you're not risking when you do have an open position. What you currently have in the market is a small allocation, right? And then we use the combination of trade frequency, compounding allocation, and adaptive logic to make up that difference and to produce on a more consistent basis because there is good trade frequency there. And so that's another reason why you see a high number of trades is we want high trade frequency. That helps our allocation model compound more quickly. It helps us reduce the amount. We can be more efficient with how our exit logic, so we don't have to try to shoot for larger returns per position. And so it just essentially, it also gives us the ability to react more quickly if there's changes in that model, because the behavior, if a model is only executing once a month or once every whatever, so once every 2 months or just twice a month or whatever it might be, it's kind of hard to identify when, or it's kind of hard to be very quick about identifying when that model might be out of bounds, right, or out of sync with the market, right? And that happens for every model at some point. Sometimes or temporary, right? That can be temporary. It can be a permanent thing. It doesn't matter. But the more frequently something is giving you a data point, the more quickly you can respond to something that needs to be changed, right? And that's the important thing, that we're always looking to apply these models, constantly update them, improve them, etc. The model that you saw though, the Alu duck, that hasn't, that's the same form. So which we're very pleased with that, and how that has shown us within the last few years throughout a pretty diverse array of market conditions, to be honest with you. So, as you can see, since 2019, there's obviously been some bull markets, right, that it's benefited from, but there's also been some extreme deviated conditions, and the model still did pretty well. So we're very, very pleased with that. And so hopefully, we take what we've learned from that to some degree, and look to be a little bit more efficient, especially with maybe like the first entry in some conditions. You don't want to restrict that as much as you possibly can, because you still want high trade frequency. So that's a fine line when you're walking between pursuing high efficiency and wanting to be consistent, right? High efficiency, high consistency, high activity. So it's a balancing act between that, and as well as the organic characteristics that the market produces. But the good thing for you guys is that's all on me. That's all on my shoulders. So for you, it's a service that's delivered to you, and so in a form of a signal service: buy at this price, this amount shares, this is your exit target, this is the X target percentage, right? And so pretty easy to follow. If you have any questions, feel free to reach out to myself at Brian@OptimizeTrading.com, or Robert Spears, my business partner. Be more than happy to help you with any questions that you might have at Robert@OptimizeTrading.com. And I'm more the nerdy the nerdy quant developer, and Rob's the more outgoing socialite. So he loves talking to people. So feel free to give him a call and go into the weeds if you want to. But Rob's a great guy. I'd be more than happy to speak with you. So look forward to it. I appreciate your time. Thank you so much. I hope I didn't put you to sleep. But I think like you kind of with these, you kind of have to walk that line between giving people enough information that they're informed of differentiating factors while not also putting them to sleep for those that's not really that interested in the space. They just, hey, what does it produce? What is the outcome of it? So, but hopefully it was something that was attractive to you. And so eventually the entire goal here is to offer a wide array of different markets. All we don't pursue any sexy, the sexiest names on the street. It's all boring, large cap, blue chip indexes, sectors, etc. At some point way down the line, we may do something with large caps, but for now it's just ETFs, right? Because those in and of themselves are diversified entities, right? So a little bit more reverting characteristics, so a little bit more organically aligned with our concept. So and we really like that. So no really reason to pursue them for now anyway. But again, appreciate your time, and I appreciate David and everyone for having me on, and have a good week, guys. Cheers.